fine-tuning the financial engine. The focus here shifts to refining an already solid financial foundation. With the essentials, debt management, banking, spending habits, and growth vehicles securely established, the groundwork is complete. Many remain caught up in the cycle of monthly bills, but a strong base allows for progress beyond that. For those eager to push further, advanced strategies can elevate the system, offering optional enhancements for the motivated. Fueling the machine. The system for growth operates smoothly, much like an automated process. Set it up, step back, and let it run. However, its pace depends on the resources provided. Consider a garden. Small seeds produce modest results, while larger investments yield abundant returns. Even modest contributions, such as $50 a month, can set things in motion. To accelerate the timeline, say from 30 years to 15, greater input is key. Every additional dollar committed today has the potential to multiply significantly over time. Online calculators, such as those found on financial websites, can illustrate this dynamic. Input a monthly amount with a 7% growth rate, factoring in taxes if applicable, and observe the outcome. Small contributions grow steadily but gradually, while increasing the amount by $150 or $300 monthly sharpens the trajectory. Initial targets, perhaps 10% of income directed toward growth, provide a starting point. To amplify results, consider negotiating major purchases, trimming unnecessary expenses, or seeking higher earnings. Early adulthood, with fewer obligations, offers an ideal window to maximize these efforts. Tuning out the static. Once the system is running, external noise becomes more noticeable. Friends or headlines questioning the approach. Common concerns might include whether to shift everything to cash during a market dip, fearing a prolonged recovery. Claims that a single stock's high returns outpace diversified options. Assumptions that renting wastes money compared to buying property. The counterpoints are straightforward. Market fluctuations are inevitable, but consistent contributions balance the highs and lows, outperforming speculative bets over time. A standout year for one investment doesn't guarantee future success. Diversity offers more reliability. Renting can sometimes be smarter than owning, depending on location and circumstances. Real estate isn't a universal win. The strength of a steady, automated growth strategy lies in its simplicity and long-term advantage. Yet, sensational headlines or hot tips can tempt adjustments. Resisting that urge is critical. Chasing trends or reacting to downturns rarely pays off. Historical market volatility, like the sharp drops and rebounds of 2020, underscores this. While many panic and sell, a disciplined approach endures. Limiting account reviews to once a month keeps focus on priorities, life's enjoyments, rather than daily market swings. With allocations set and funded, temporary setbacks fade into the broader upward trend. Keeping the balance a diversified portfolio requires occasional adjustments, much like maintaining variety in a balanced diet. If one segment, such as global markets, outperforms, it can overshadow the intended mix. Periodic rebalancing restores equilibrium. For example, a target allocation might aim for 40% domestic stocks, 30% international, 20% bonds, and 10% real estate. If domestic stocks climb to 60%, pause contributions there and redirect to the underrepresented areas. Online tools from investment platforms can simplify tracking. Selling is an option but often introduces complications, fees, taxes, and effort, making it more practical to bolster the lagging segments instead. Automated options, like lifecycle funds, handle this effortlessly for those who prefer simplicity. Taxes. Chill-out taxes tend to stir unnecessary worry. The reality is straightforward. They apply only to gains, meaning a 30% tax bill reflects a 70% profit, a net positive. Public services like infrastructure rely on these contributions, adding perspective. The simplest approach is to maximize tax-sheltered accounts, such as retirement plans. A 401k postpones taxes for years, while a Roth secures tax-free growth. Complex strategies suit higher earners. For most, sheltering what's feasible and holding long-term keeps things efficient. Selling introduces another tax consideration. Gains realized within a year face a higher rate, often around 28%, while those held longer drop to 15%. Inside sheltered accounts, this distinction doesn't apply. Trades incur no immediate tax. This favors broad, long-term holdings over frequent stock picks. Unless managing a sizable portfolio, this covers the essentials. When to cash out selling is uncommon in the early stages, reserved for specific scenarios. Emergencies. Exhaust savings first, then sell non-essential items online, often at lower than expected prices. Family loans, if viable, come next. Retirement accounts are a last resort. Roth principal withdraws without penalty, but 401k penalties hurt. Credit cards are a final, reluctant option. Underperforming assets. Broad funds reflect market trends. If the market dips, patience is usually best. However, a single investment lagging its sector might justify a review. Research via financial sites can clarify whether it's a temporary dip or a deeper issue. Goal achievement. When a savings target for a specific purpose is reached, liquidating to fund that goal makes sense. Short-term needs belong in savings, while longer-term objectives align with investing. Beyond the basics, giving and growing for many, financial life remains tangled in routine struggles, debt, impulsive spending, or creeping subscriptions. A streamlined system, however, clears the path. Bills are managed, spending is intentional, and adjustments are seamless. This opens opportunities to look ahead. Conversations with those further along often highlight practical steps. Build an emergency fund covering 6 months. Secure insurance as responsibilities grow. And consider education savings plans once personal finances are stable. Wealth can also extend beyond personal gain, becoming a means to contribute. Small actions, donating to a local cause, volunteering time, or sharing financial insights, create ripples. Platforms connecting to global initiatives offer accessible starting points. Impact grows over time, paralleling a well-managed portfolio. With the system running smoothly, there's room to envision broader possibilities. The journey continues with topics like managing money in relationships, navigating major purchases, and handling everyday financial challenges. The foundation is set, momentum carries it forward.